Hello and welcome back to Building Wealth on the Go, a podcast by KLT Wealth Management. Today is October 15th, 2024, and we are back with Season 5, Episode 8 of our podcast. I'm your host, Brad Wilson, joined by my colleagues Courtney Beach and Joe Filiameni. And we're here today, fresh off a Thanksgiving weekend with bellies full of turkey, to discuss the exciting topic of tax planning. Believe it or not, we are not too far away from the end of 2024. It's an important time to start gearing up for the final year-end tax planning. There's a lot of deadlines that happen when we close out the year at December 31st. So I think it was important to sort of bring this to light here just over a few months out. So I think let's sort of dive in right off the bat with what are some things to sort of keep in mind, look out for as we sort of approach that deadline there, Courtney.
No, well, first of all, the deadline's April 30th this year for individuals and June 16th for self-employed people. It seems so far off, but before you know it, it will be here. So I think the most popular one is to get your RSP contributions in.
Nothing like scrambling in January, February, to get your RSP contributions. Probably not a bad idea to do a quick calculation, even year to date, taking a look at your paycheck and seeing where you're at. Do I need one? Do I not need one? At least you're planning to have those dollars there. And totally makes sense to kind of start thinking about it, but it's hard. Like we're heading into like Halloween season and stuff, and then November, December. We really don't want to think about taxes until April of next year for sure. But it's a necessary evil.
I think it's important, Joe. You bring up the point of seeing where your income's been year to date. It's not a bad time to do a little bit of a check-in, see how the year's gone. Most people, what salary's coming in. It's easy enough to check that on a pay stub, a recent pay stub. For people who are self-employed, trying to tally maybe a little bit of a year to date, get a sense of where your taxes are. Are you up to date on your installments? Installment payments, are generally you're either September or December, even October. So making sure you've been up to date with your installment payments. The RSPs are a great thing. We do have a little bit extra time, which is nice into the new year. But one account where we don't have extra time, if your goal is buying a house, is the first home savings account. That deadline for contributions is December 31st. So if you have opened up a first home savings account or are looking to, now's the time to do it and to make a contribution before year end, because you don't get the grace period in the new year like you do with an RRSP. So if you want that tax break, you want to make sure you get that contribution in before year end.
Yeah, because the idea is if you open an account this year, you'll get your room. I think it's $7,000 a year.
$8,000 this year, yeah.
8,000.
Yeah.
But you don't have to necessarily put it in this year. You still, like, if you can't get it in by the end of the year, they give you a year's worth of extra room to carry forward. So you can do it in the new year, but you have to get that account open by the end of the year.
Mm-hmm, mm-hmm. Yeah, and so then if you do contribute next year, it'll roll over. You'll get the tax slip for the following year. So if you're looking for a break this year, get it in now, and that's a really important one. I think another one, Joe, with sort of what we've seen this year with the changes to capital gains, is looking at some capital gains triggering or capital loss, maybe some tax loss selling. Maybe what are some strategies there that should be important for people to look at?
Yeah, often we take a look at the situation as we're kind of heading to year end in terms of any non-registered money that a client might have that's exposed to tax. Taking a look at what capital gains have been triggered, and maybe it's time to sell some of those loss positions as well. Take a little bit of a loss. That's going to help offset any other gains. You got to keep in mind there's two types of gains or losses that generally occur. There's the ones that you actually trigger, and then there's the ones that come on the T-slips at the end of the year. So at the end of the year, there's often, capital gains that are recorded there, and they are all taxable. And of course, tax laws change this year, effective June 25th, where the capital gain inclusion rate went from 50%, which we loved for the longest time, we got to enjoy, and now it's at 67%. Now, on a personal basis, it's anything above the $250,000 mark essentially would be subject to the higher inclusion rate. So it's definitely worthwhile looking at that and talking to both your accountant and your financial advisor at the same time. I think it's important. Right now is sort of a sweet spot with the accountants because they're kind of getting back into the groove of things after the holidays. It's a great time. They have a bit of time. They're starting to work on corporate year ends, but they have a bit more time than they would come January, February into the new year because then they're heavy into tax and tax preparation. So it would be worthwhile to, again, get your estimates, and they'll help you with the calculation on the RSP contribution that we talked about as well.
I think one thing too to sort of as you approach year end, getting into next year, start to sort of organize and gather some receipts. There's lots of things that you can claim to help you out on your taxes. If you've had a year where you've had a lot of medical expenses, that's actually something you can write off as well. So sometimes people forget or don't know that you can put together those medical expenses. Now, there's a minimum threshold you have to clear before it becomes a write off for you, but it's usually about 3% of your salary. But you can combine those as a family household of your spouse and your dependents, and put it on one tax return. So those are things to think about. Obviously, if you're self-employed, gathering and organizing stuff now is always a good idea to get ahead of that. And looking into those tax credits, what might you qualify for? There's lots available, depending on your situation, and working with tax professionals or your advisors to help sort of make sure you're maximizing those situations, would be a good idea as well.
I think what falls in along with that idea is the charitable donation receipts. Like now, as we kind of head into the final stretch of 2024, get your charitable donation receipts in. It really is a great time because we're still in sort of a just gearing back into work mode. So it is really a great time to kind of organize yourself for your taxes and things like gathering receipts, whether it's self-employment receipts or charitable donation receipts, makes
Yeah.
sense as well.
And remember, as far as charity goes, you can also donate some of your units of your investments as well. So if you're sitting on a non-registered account with a lot of capital gains, you don't, you can spare the money for charity. You're going to give to charity anyway. You can give that in kind. You don't have to pay the capital gains on it, and the charities get an exemption. So they don't either. So it's two things at once. You save on the taxes and you get to give to your charity of choice as well.
It's a big strategy I know we implement here in the office, and quite honestly, it's one of the last remaining sort of strategies that the government allows you to do is making those in-kind donations to charity, using investments, outside investments, let's say non-registered investments that are sitting with large capital gains. It's a win-win for everybody in those cases.
Yeah, and I think the opportunity too presents itself, especially if you run into a situation where you find yourself donating those units or whatnot, is the opportunity to maybe even create your own charitable foundation, right? If you find yourself giving quite often, and that's something that's really important to you, the idea of building your own foundation that can create a giving strategy, not only today, but in the years to come, even beyond your years here as well.
And the nice thing about a foundation is you can name it, basically what you want. You can give to the charities that you want. You can change them up. If there's a new charity that pops up that you want to give to instead of another charity you used to, you can change them. So there's some flexibility there with a foundation. So if you're somebody who regularly gives every year and you need that tax break, you can set up your own foundation.
No, for sure. And I think, when we step back and sort of look at tax planning, it becomes very different depending on the stage in life you're in, right? As when you're younger, you're starting out a little bit more, you're building up, you're trying to earn as much income as you can. You're going to be paying a lot of taxes, and there really isn't a ton of tax breaks you can get other than contributing to your RSPs, utilizing your registered investment accounts. But where it really becomes a big factor is when you're in retirement, is you're really starting to minimize your taxable income and take advantage of all the benefits that exist out there. So I think it's important that we touch on some of those strategies as you're approaching that pending retirement. You're looking in retirement, and you don't want to be subject to any penalties for super high income in retirement or losing out on any benefits, right? I think the big one off the gate that a lot of people are concerned about is losing out on old age security, because if your income's too high in retirement, your taxable income, they can claw back the old age security. So there are a lot of strategies out there. Joe, maybe what are some that we can sort of, people maybe might not be aware of that they can take advantage of as they are in retirement, that they're filing taxes that can help to reduce sort of their individual incomes?
Probably the biggest thing in that age group, in the retirement age group, is the pension splitting. That's been with us for a number of years. I know that there still are couples that insist on, filing their income tax returns separately. So whether or not they're taking advantage of the pension splitting, it really reduces the tax payable for both parties. And one of the key things when you're looking at the taxes that I owe, don't look at the dollar amount that you're paying. Look at the percentage of tax payable based on the taxable income. Because often people will say, oh, I had to pay, I don't know, $5,000 in taxes, you know, but take a look at that percentage of the total payable against the taxable income. And what's that percentage? And if you're paying, 10 or 15% sort of taxes, you're in the lowest rate that you possibly can. So sometimes due to, not making your installments or being subject or having extra income that year, you have to pay a little extra, like, of the dollar amounts. But if you look at the percentage, you're still paying at the lowest rate and stuff. So that I always try to kind of bring that back in with clients, is to look at the percentage that they're paying.
And one thing to remember, if you are riffing and you're taking your OAS and CPP and you get that large tax bill at tax time, and you've looked at the percentage like Joe said, and you're still got that big bill, is you can take what's called withholding tax off your RIF and LIF payments. So you can prepay some of the taxes in advance so that you don't have that big bill in April. So you might want to talk to your financial advisor or see if that's something that will work for you.
Yeah, no, I think those are both great strategies. I think some things people don't realize as well is you do get sort of age credits once you get older as well. The government really does try to help you out with some more credits when you do get older. So there is that possibility. And then medical expenses, again, as you get older, those things add up. It's important to keep those receipts, as that could help you when you do get older. But also doing a little bit of financial planning on the tax side of where is your income coming from? Is it coming from accounts that are causing you to increase your taxable income, or are they coming from, is it being balanced out? And you're doing some good income planning of where is that money coming from to help fund your lifestyle and your retirement, and making sure that you're minimizing that tax payable. And that's where it's important to sit down and, have your advisor connect with your accountant, work on those strategies. And maybe there's a strategy that needs to be in place to melt down your RIF, right, at some point in time too, because those RSPs that you funneled money into when you were younger, if those do really well and they've built up a really big account, they can become a bit of a tax liability as you get older. And then I think it's important to look at strategies to really melt those down in an efficient way without triggering too much or paying too much tax now, because those become a big liability when you pass away. And so looking at strategies of drawing that down quickly, and even looking into funneling some of that money into life insurance would be really important. And the earlier you look at that, the better off you'll be into creating sort of a really tax efficient retirement income, and also estate as you get older.
Yeah, but one thing to note about that strategy, you have a good point there, Brad, is that's on final passing. So if you're married or common law, your accounts, as long as they're marked properly, should just slide over to your spouse with no tax consequences. But yes, on final passing, that is a big liability for some people.
So we'll touch a little bit now. We'll just dive to a little bit of the market outlook here as we approach sort of November and U.S. election time. But if I do check here, post Thanksgiving, the markets have continued to run strong. Some new all-time highs yesterday on the S&P 500. It's been a lot of good news, a lot of positive. The bulls continue to rage on in the markets. So, what are your thoughts now on what you're seeing there, Courtney, in sort of the market?
Um, I'm not really sure what to think, to tell you the truth. I am expecting a bit of a blip after the election, no matter who wins. That's normal. But I don't know. I like it just seems like we keep trucking along. We have had wars, we've had all these announcements, and like it just seems like it never ends when it comes to the news cycle, but it really hasn't affected the market that much.
Yeah, and I've noticed too on the technical side, I've been kind of watching that a little bit, and there's a bit of a narrowing of the markets that's happening, and that uh, generally gives a sign, and the sign could be positive or negative. So when we're narrowing the markets and things are coming in tighter, then there's a potential of a breakout to the upside, in which case then we're starting again another growth leg or a pullback to the downside. And most of the technical analysts that I follow says nobody seems to want to put their finger on exactly which way to go. So nobody has their crystal ball quite shined up enough so that they can see what's happening. But it certainly has been a very, very good market
Hmm.
for most part.
Yeah, it's been strong, and it's been one where those out there taking a lot of risk have seen the reward for now. But there's lots. I think there's more and more people treading with a little bit more caution these days. Just like you said, Courtney, the news cycle, the wars seem to be intensifying overseas. It seems like conflicts rising at an all-time high. The polarization, the politically, especially in the states, continues to be pushing. And we're like 3 weeks out from the election at this point. That's only going to intensify. And like you said, doesn't really matter who wins. There's going to be some sort of fallout. So it will be interesting to see what sort of happens, and I'm sure we'll have plenty to discuss on the next
Yeah.
podcast. What happens the next few
Yeah.
weeks?
I just think everyone, when it came, we went through COVID, everyone was like, we got out of COVID, everyone's excited and happy. And the bubble's got to pop at some point. The question is when.
Yeah, no, exactly. So with that, we'll kind of close out the podcast with Joe's tip of the month here.
Yeah, I was actually going to talk about the capital gains and stuff, but it's kind of a little bit of a boring topic. Of course, taxes. I love taxes and stuff, so I can talk for hours about it. But on our last point in talking about the markets, and I'm bringing this forward only because this happened to me on the weekend, chatting with somebody, and seeing that the markets have grown so much, right? And have done so well this year. And then you're looking at your portfolios and you're trying to compare. And in this particular, this person basically investments were up like 13%. And you're thinking, oh, wow, double digit, 13%. They're not quite at a growth mode. They're probably slightly more conservative than growth, but 13%, it seems like a great return. The person wasn't very happy, and so then you kind of look at things and you think, okay, well, why aren't you happy with a 13% growth? Well, then you hear about um, things such as Nvidia being up 80% in specific stocks, and you say, well, I want those stocks, and I want to buy into it. So it's that fear of missing out, which we've talked about before. And so I would rather be in a specific stock. So then I questioned in terms of, well, how much are you going to put into that stock? Will you put 5,000? And if it doubled, that's 10,000. Are you happy with that? It's just it's $10,000. Well, yeah, I guess. But what if you lost the 5,000? Or are you going to put 100,000? And what if you lost the 100? Would you be happy? So sometimes, it's nice to get sort of a nice slow and steady sort of return in your portfolio. So don't beat up your financial advisor when he tells you what the rate of return is in your portfolio, because remember, that's got to match your risk profile too. But take it sort of, in stride, in that, if I made 5% this year, 8% next year, 10% the other year, I'm accumulating wealth and I'm contributing to it. And that's going to grow your wealth, and that's going to get you to where you want to go with that particular investment.
Mm-hmm. No, that's great. I think just to tag on to that, Joe, I think when you've been in a year, you've been in a cycle with a lot of really strong positive years, that little birdie starts tweeting a little louder in the back of your ear saying, oh, there's more out there, there's more out there. And then what happens is you move and we see a market pullback, and then those
Yeah.
people lose their money. So that's the emotion of the industry that we
Yeah.
work in.
I think some people forget that safety and security has value too. It might not be
Yeah,
a dollar sign value, but it has value.
Yeah.
absolutely.
Peace of
Yeah.
mind, sleep.
Yeah, absolutely. So that wraps up our podcast here for October. We will be back next month with lots to discuss post US election and heading into the final 6 to 8 weeks of the year. So thanks as always for tuning in. Make sure to leave a like and subscribe on whatever platform you're on, and we'll be back next month.